in the US international tax space, most practitioners are comfortable talking about income taxes, whether they be for individuals or for corporations. When it comes to transfer taxes, gift or estate taxes, residency revolves around the concept of domicile. If it is that someone is deemed to be domiciled in the US, they get a huge lifetime exclusion. Right now, at the time of recording, this is January 2024, and for 2024, the inflation adjusted lifetime exclusion is $13,610,000 US dollars. So for most people, the idea of an estate tax obligation is out of the question because that's a pretty high threshold. If someone is deemed to not be domiciled in the US, the threshold is just $60,000. And for most non-US employees who would have received equity awards from US companies and have never worked in the US, or they have no US immigration status, they've never lived in the US, chances are they would be deemed not to be domiciled in the US. And as a result, they will face the lower exclusion of $60,000. There are just a few ways of legally avoiding this obligation. Firstly, if the person who's passed away was legally resident in one of the 15 jurisdictions that has a double tax agreement with the US, which considers estate taxes, for example, France or the UK, then under certain circumstances, this obligation to the US could be legally avoided. Two would be for that non-US employee who would have received the award to have liquidated their US Situs assets before they pass away. Obviously, under certain circumstances, this may not be possible because sometimes there's a lockup period or some of the terms and conditions attached to the award, which may make this impossible. A third option would be, where possible, for these individuals to transfer their US holdings into some sort of offshore company or offshore trust structure, which would serve as a legal estate tax blocker from a US perspective. My name is Darren Joseph from HCJ.tax.